Are you worried about your investments? Do you see the headlines about AI stocks soaring and wonder if you're missing out? Or maybe you're concerned about the rising debt levels and talk of a market crash? It's a confusing time for investors. It feels like the rules of the game are changing every single day. But what if there was a way to navigate this uncertainty? What if you could invest with the same confidence as one of the greatest investors of all time? Imagine having a clear strategy that helps you build wealth no matter what the market is doing. That's exactly what we're going to explore in this video. We're going to look at the timeless wisdom of Warren Buffett and apply it to the challenges of 2026. So, if you're ready to stop feeling anxious about your money and start building a secure future, you're in the right place. Let's first talk about what's happening in the market right now. It's a mix of incredible opportunity and significant risk. On one hand, we have the AI revolution. Companies like Nvidia and Palantir have seen their stock prices explode. The AI industry is projected to grow from around $279 billion in 2024 to approximately $3.5 trillion by 2033. That's a massive opportunity. That kind of growth represents a compound annual growth rate of 32% over the next 8 years. But on the other hand, we have some serious warning signs. The Buffett indicator, which compares the total stock market valuation to the GDP, is at 217%. That's a level that has historically signaled an overvalued market. When this indicator gets this high, it means that the total value of all stocks is more than twice the size of the entire economy. History has shown us that when valuations get stretched like this, corrections tend to follow. We're also seeing record levels of margin debt. Margin debt reached a new all-time high of $1.13 trillion in September 2025. This means people are borrowing more money than ever to invest in stocks. This can amplify gains when the market goes up, but it can also lead to devastating losses when the market goes down. When investors are forced to sell because they can't meet their margin calls, it creates a downward spiral that accelerates market declines. And then there's the debt issue. Big tech companies are taking on billions in debt to fund their AI ambitions. Meta's recent $30 billion deal for a new data center in Louisiana is a prime example. This is the largest private debt deal ever. 80% of the facility will be owned by Blue Owl Capital, with Meta retaining only a 20% stake. This isn't the cash-rich, risk-averse tech industry we're used to. This is a new era of debt-fueled growth. According to Morgan Stanley's chief investment officer, Lisa Shallett, this shift to debt financing is a signal that the bull market in tech is getting weaker and weaker as the days go by. When companies start using debt instead of cash from their balance sheets, it creates pressure to actually earn a return on that investment. So, what does this all mean for you? It means that the get-rich-quick schemes and a buy-everything mentality are more dangerous than ever. It means that you need a solid, proven strategy to protect your capital and grow your wealth. And that's where Warren Buffett comes in. Warren Buffett's first rule of investing is simple: don't lose money. His second rule is never forget the first rule. This might sound obvious, but in a market driven by FOMO, fear of missing out, it's a powerful reminder to prioritize capital preservation. Buffett isn't trying to hit a home run with every investment. He's focused on consistently getting on base. He's not a speculator. He's a business owner. He buys companies, not stocks. This is a crucial distinction. When you buy a stock, you're buying a piece of a business. You should understand that business inside and out. This is why Buffett famously passed on Google and Amazon in their early days. He admitted he didn't understand their business models. He sticks to what he knows. This is his circle of competence, and it's a principle that can save you from making costly mistakes. Think about it this way. If someone offered you a chance to invest in a business in a language you don't speak, in an industry you've never studied, would you do it? Probably not. Yet many investors do exactly that when they chase hot stocks they don't understand. They hear about a company on social media or from a friend, and they buy it without doing any real research. That's speculation, not investing. So, how can you apply this principle in 2026? First, resist the urge to chase the latest hot stock. Don't invest in something just because everyone else is. Do your own research. Understand the business. What does it do? How does it make money? What are its competitive advantages? Second, focus on companies with a proven track record. Buffett typically only invests in companies that have been around for at least 10 years. This gives him a long history of performance to analyze. It shows him that the business can withstand the test of time. And third, be patient. Buffett once said, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes." This long-term perspective is the cornerstone of his success. It allows him to ride out the short-term volatility and benefit from the long-term growth of the businesses he owns. Buffett is a value investor. He learned this approach from his mentor, Benjamin Graham. Value investing is about buying stocks for less than their intrinsic value. It's like buying a dollar for 50 cents. This provides a margin of safety. It protects you from losing money if your analysis is wrong or if the market takes a downturn. So, how do you determine a company's intrinsic value? It's not an exact science, but it involves analyzing the company's fundamentals. You need to look at its earnings, its assets, and its growth potential. You also need to consider its economic moat. An economic moat is a competitive advantage that protects a company from its competitors. It could be a strong brand, a patent, a network effect, or a low-cost production process. The wider the moat, the more sustainable the company's profits will be. Just like a moat around a castle protects it from invaders, an economic moat protects a company from competitors who want to steal its customers and profits. In today's market, with so many companies competing in the AI space, a strong economic moat is more important than ever. It's what separates the long-term winners from the short-term hype. Let's look at an example. Think about a company like Coca-Cola. Its brand is its economic moat. People all over the world know and trust Coca-Cola. This allows the company to charge a premium for its products and generate consistent profits year after year. Even if a competitor creates a similar tasting cola, consumers will still choose Coca-Cola because of the brand recognition. That's the power of a wide economic moat. Now, think about a new AI startup. It might have a great product today, but does it have a sustainable competitive advantage? Can another company easily replicate its technology? If the answer is yes, then it doesn't have a wide economic moat. And that makes it a much riskier investment. Technology can be copied, patents can expire, but a strong brand or network effect is much harder to replicate. This is why Buffett is so cautious about investing in technology companies. He's not against technology, he's just very selective. He wants to see a clear and sustainable competitive advantage before he invests. Another key concept in value investing is the margin of safety. This is the difference between a stock's intrinsic value and its market price. If a company is worth $100 per share based on your analysis, but it's trading at $60 per share, you have a $40 margin of safety. This cushion protects you if your calculations are off, or if unexpected problems arise. Buffett never buys a stock unless he believes it's trading below its intrinsic value. This principle ensures that he's buying quality businesses at reasonable prices. So, what is Buffett doing in the current market? He's practicing what he preaches, he's being patient, he's waiting for the right opportunities, and he's holding a lot of cash. Right now, Berkshire Hathaway, Buffett's company, is sitting on a massive pile of cash, over $344 billion. And a large portion of that, approximately $314 billion, is invested in short-term U.S. Treasury bills. This tells us a few things. First, it tells us that Buffett is not finding many attractive investment opportunities in the current market. He believes that many stocks are overvalued. He's not willing to overpay, even for great companies. This is discipline in action. Second, it tells us that he's preparing for a potential market downturn. He's keeping his powder dry. He's ready to deploy that cash when prices come down. This is when he makes his best investments. As he famously said, "Be fearful when others are greedy, and greedy when others are fearful." Remarkably, Berkshire's Treasury bill holdings now exceed the Federal Reserve's own holdings, which stand at about $195 billion. While the Fed has been reducing its balance sheet, Buffett has been ramping up. He's earning steady yields, currently around 4.8%, without the volatility of stocks. Buffett is also trimming his positions in some of the market's biggest names, like Apple and Bank of America. This doesn't mean he's lost faith in these companies. It just means he's managing his risk. He's taking some profits off the table after a long period of strong performance. At the same time, he's making small, selective investments in companies like Nucor and United Health Group. This shows that he's still finding pockets of value in the market. He's not just sitting on the sidelines. He's being patient and disciplined. This strategy is a masterclass in risk management. In an era of elevated stock prices and economic headwinds, Buffett is positioning Berkshire to capitalize on a potential market downturn. By staying liquid, he is ready to acquire quality assets at steep discounts during a crash. So, how can you apply Buffett's wisdom to your own investment strategy for 2026? Here are the key takeaways. First, build your own circle of competence. Invest in what you know and understand. Don't be afraid to say no to an investment if you don't understand the business. There will always be other opportunities. Focus on industries where you have knowledge or experience. Second, focus on value. Look for companies with strong fundamentals, a sustainable competitive advantage, and a reasonable valuation. The price you pay determines your return. A great company at a terrible price is a terrible investment. A good company at a great price is a great investment. Third, be patient. Don't feel like you have to be constantly buying and selling. The best investors are often the most patient. Wait for the right opportunities. And when you find them, be prepared to act decisively. Fourth, hold cash. In a volatile market, cash is king. It gives you the flexibility to take advantage of opportunities when they arise. It also provides a cushion during market downturns. Don't feel pressured to be fully invested at all times. Consider following Buffett's example by investing some of your cash reserves in short-term Treasury bills. You can do this through exchange-traded funds like the iShares 0 to 3-month Treasury Bond ETF or the SPDR Bloomberg 1 to 3-month T-bill ETF. These funds offer yields around 4.8% with minimal risk. And finally, think for yourself. Don't follow the herd. Do your own research, make your own decisions. As Buffett said, the most important quality for an investor is temperament, not intellect. You don't need to be the smartest person in the room. You need to be disciplined. You need to control your emotions. Investing in 2026 won't be easy. The market is facing a unique set of challenges. We have soaring AI valuations. We have rising debt levels. We have concerns about overvaluation. But by following the timeless principles of Warren Buffett, you can navigate this uncertainty and build a secure financial future. It's not about timing the market. It's about time in the market. It's about discipline, patience, and a long-term perspective. It's about understanding the difference between price and value. It's about buying great businesses at reasonable prices and holding them for the long term. Remember, you don't need to be a genius to be a successful investor. You just need to be disciplined. You need to have a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. So, take a deep breath, tune out the noise, and focus on what really matters. Building a portfolio of great businesses that you can own for the long term. That's the Buffett way, and it's a strategy that has stood the test of time. Thanks for watching. If you found this video helpful, be sure to like, subscribe, and hit that notification bell so you don't miss our next video. And let us know in the comments below what you think about Warren Buffett's advice. We'd love to hear from you.